All right, people, welcome back to a new YouTube video. So what we're going to do today is we're going to do some analysis on the US dollar. We're going to do fundamental analysis and then some technical analysis, and we're going to generate some trade ideas. So the first thing we've got to note is that we've recently seen this pullback on the US dollar. Now, I've heard a lot of people saying, oh, major shift in the trend. But if you zoom out ever so slightly, you will clearly see that this market structure is very conclusively bullish market structure. I don't know how you could really disagree with this. Higher highs, higher lows, higher highs, higher lows, etc. Right? Pretty clearly, very bullish market structure, and we've only recently had this kind of a little bit of a slowdown, a little bit of a pullback. Right? Now, if we look just purely at the technicals, you can see we've created this pretty strong rejection area here, this double top here, and we've come down pretty strong. Now, what has been the reason for this pretty sharp pullback? Well, let's get into it. So if we head over to Forex Factory, we can basically run through the key data points that have caused this kind of slowdown in the US dollar. So the data points that I see as the most important here is we have flash manufacturing and flash services PMI weaker than expected, and flash manufacturing was in this non-expansionary territory below 50. We had advanced GDP come out significantly below forecast. We had consumer confidence was pretty weak. The more PMI numbers, ISM manufacturing PMI numbers, weaker than expected. JOLTS job openings weaker than expected. FOMC, we had a pretty, rates remained unchanged at a relatively neutral FOMC as compared to the market was expecting a slightly more hawkish FOMC. So overall, that was pretty neutral. Then we had the big one, the real catalyst of this move. The real catalyst was NFP, right? The jobs data. We had poor average hourly earnings, lower than expected. NFP, worse than expected. And the unemployment rate came out higher than expected, which is worse than expected. And also ISM services PMI came out, in this non-expansionary territory below the forecast. So all of this data basically is indicators of economic slowdown, right? So these are indicating some economic slowdown, which has basically driven the dollar down. Why has it driven the dollar down? Well, because economic slowdown means we're likely going to see inflation come close to the target, and also which increases the probability that the Fed will cut rates. And cutting rates is, of course, bearish for the currency, right? So that's basically softening the US dollar ever so slightly. But with that being said, we trade, currencies against other currencies, right? So it's not just about, understanding the US dollar in isolation. We also have to compare it to its other peers. And this is why I'm still bullish on the US dollar, because when we compare the US economy and the US economic data to its peers, such as the euro, such as the pound, it's still very much in a dominant position, right? We have still in the US, let me just write it out, we have sticky inflation, a stronger economy than peers, and that's the main kind of two things. Yeah, just rate cuts are less likely. Rate cuts less likely soon. Less likely. Obviously, rate cuts are highly likely overall, but they're likely to be held higher for longer. The rates, right? So we're going to see rates higher for longer, most likely in the US, when we compare it to the euro, pound, etc. And for that reason, I remain bullish on the US dollar. And if we look at the Dixie, I do expect us to not really see much more downside than this. We may come down here, but overall, I think this trend is simply going to continue. Just got to wait for that 4-hour bullish market structure to form. Now, if we head over to some of the other currencies, so we'll head over to Euro USD. So if we head over to the Euro USD, you will see that, again, it's very similar to the US dollar. We're still very much in a bearish downtrend, although we've seen this recent strength in Euro USD. Now, how I see it is we've had this strength, but we're still very much in this bearish market structure, and we're coming into strong levels. And my macroeconomic outlook is still very much bearish because it's highly probable that the Eurozone, the ECB, will be cutting rates before the Fed, which is simply going to drive outflows of euro and inflows into the US dollar, right? Because the US dollar is going to be far more attractive as an investment. And, that big money is going to be flowing into US dollar, which is going to drive Euro USD down. Now, that's the kind of thing that I'd be expecting. I would not sell into this strength without seeing some confirmations of bearishness, right? So just what I'd look for, this isn't enough. I'd want a bit of a sharper move, a bit of a break of structure, and then I think we'll resume that downside pressure. If we look at the GBP USD, it's very much the same picture, right? We've had this retracement, but ultimately we're coming into these strong levels, and it's just a matter of waiting for a little bit of a sharp move down, retracement, and then get in for continuations down. USD CAD, very similar, just obviously the opposite. We've come into these strong areas here, these previous highs. And again, just waiting for a little bit of a snap to get in. Obviously, I wouldn't enter in every single pair, but you catch the point, right? Those are kind of the main ones. Also, you could trade USD JPY, similar kind of outlook. You do have to be cautious with yen interventions. So I'm a little bit more cautious trading this. Although down at these levels, it's entirely possible to get an entry, and but if we came back to these highs, I would be very cautious, right, of yen intervention. And then we have USD CHF. This one, this one I'm not as interested right now. I do think you could also just, look for this. Again, just waiting for maybe a little bit of a break of structure and continuations. And that's all I've got down there. There is, a couple more US dollar pairs. But to be honest, the outlook is pretty much similar with all of them. The US dollar is the dominant currency compared to pretty much all of the major currencies right now. So you're going to be wanting to trade in line with the US dollar. We are obviously seeing that weakness right now, but in my opinion, the overall macro outlook is still very much dominant for the US dollar due to the reasons I spoke about previously. So I'm going to continue to look for US dollar longs. I don't want to get in multiple positions all with US dollar, because then I've got too much risk on this one trade idea of US dollar longs. But that's very much my outlook. So we'll see how it plays out. It is, of course, as always, massively going to be data dependent. So we'll see what happens with the data. Because, for example, we have CPI on the 15th of May. And if we do see significant drops in CPI year over year, core CPI, etc., that will slowly begin to shift the outlook, and we will see deeper retracements. But overall, this is definitely the picture. That dominant US dollar, I think, is just going to simply continue. So let me know what you think of my analysis, and I hopefully you find it useful. And yeah, I'll see you in the next video.